Good morning. This is Nick Rach with the Earnings Scout. And what I want to do is go over today's third quarter 2024 EPS estimate revision update. Now, we update these estimate revisions every Monday. We think the Monday reports that we send are critically important because they're always measuring the direction of estimate changes as opposed to just calculating what's being reported in the current earnings season. The next quarter estimate changes we find to be a great leading indicator of how overall earnings expectations are going to change. And we're going to show you how it really doesn't matter if estimates are going up or down, but how they're moving across times to determine if expectations are getting better or worse. There's a huge difference between knowing if estimates are going up or down or getting better or worse. We're going to show that in today's report. But I want to bring to your attention some of the things in the report to look at. Specifically, one thing that we look at is on page 2, and we think this is really important. We have this chart here showing the rate of change to overall S&P 500 estimates over the last 3 years. And if you look in here over the last 3 years, in late 2021, we have this alligator jaw where our estimates, where we have earnings scores, were being raised at lesser rates towards the end of 2021 as the price of the S&P 500 kept going higher. That was an alligator jaw that we say, and we define that by 2 quarters in a row or more of weakening estimates on a rate of change basis for the S&P 500 and rising price. That's happened 7 times over the last 35 years, and that has always led to, at minimum, a correction, and it has preceded all of the major bear markets over the last 35 years. So what we're doing is measuring multiple quarters, multiple years of estimates in a proprietary blend, and determining if estimates are going up or down with the earnings score, and then measuring that across time. And if you look through here, the market bottomed in October of 2022, right when the overall estimates were being cut by their worst amount of 5.5%. Why was 2023 a good year for stocks? Well, the estimates were being cut, but they were being cut at lesser rates. That's an improving delta. Improving delta justifies a higher multiple on the market, higher stock prices. But I want to draw your attention to something that's occurred over the last year. So 2023 was justifiably higher. What we're seeing now, the positive revision trends over the last year, have more or less, right here, if you draw this trend line in, have begun to stall out. And specifically, what we've seen, we saw estimate trends weaken in the third quarter of last year. Then they stalled out in the fourth quarter in reporting season. Then in first quarter reporting season, we actually got an improvement in earnings estimates again, only to see them weaken again this earnings season. And what do we mean? We're drawing a teenage alligator jaw there because it's not quite what we would define as an alligator jaw, but it's elevated the PE multiple. But we want to show you specifically in the scorecard on page 5 of today's report. And if you look, there's been 464 S&P 500 companies that have reported second quarter earnings. And this is the third quarter 2024 EPS estimate change scorecard. So what we take of those 464 and aggregate them, on average, what we've seen is their estimates fall at a rate of 2.14%. Does that mean all the companies are seeing their estimate cuts? No. 34%, one out of three of these 464 companies are actually having their estimates raised. 10% were maintained, 56% saw the estimates cut. Now, that minus 2.14% isn't a number to get bullish or bearish on in either way until you look at where it's been moving in the past. And if we look, these third quarter estimate changes right here, how did they compare to last quarter when companies were reporting their first quarter estimates? The next quarter estimates corresponded to the second quarter 2024 period. And what we've seen here is the magnitude by which estimates are cut this earnings season is a little bit steeper. So that's a weakening trend. And we graph this out at the bottom of the page for you. And again, we're going to bring this back to over the last 3 years. This alligator jaw opened in late 2021, where the estimates were being raised during second quarter 21 earnings season, and then we see them getting cut at increasing rates. And 2022 was a year for stocks that was bad. The S&P had a peak to trough decline of 23%. Why? Because the estimates for the next quarter period after companies reporting were getting cut at increasing rates. And we're going to draw your attention to this 4.97 bar right here. This is the fourth quarter 22 revisions that occurred in third quarter 2022 earnings season. Why is that important? This is when stocks bottomed, which were being reported in mid to late October. And as companies reporting their third quarter earnings for 2022 in October 2022, that's when the estimates were being cut by their highest amount. When the worst of the revisions occurs, this is when we see stock prices bottom. It's occurred every time over the last 35 years, plus or minus 3 months of the worst of their cuts occurring. And then in 2023, we see the estimates being cut at a lesser rate. And then here we see the estimates weaken last year, a year ago at this time, where they fall from 1.9% down to 3.29. Then it leveled off. And then we got an improvement in first quarter earnings season, only to see these estimates being cut again at a rate of 2.14%. And as the estimates are being cut, we're going to go back to the front page and show you what this is doing to the market multiple. Market multiple by itself is not a timing indicator, but a risk metric in our opinion. And what we have here are definitely elevated PEs on weakening earnings. This is why we think you should remain cautious on stocks, particularly because we're seeing concentrated returns again amongst the Magnificent Seven. And that poses inherent risk as well. But that's how you read our third quarter report. We wanted to show you that, bring it to life. In case you had any questions, you may feel free to contact me in any way you can. We're here to help, and I hope you're finding this trial very useful. Thank you.